may be hard to believe at the moment, but yes, there are absolutely reasons for investors to have optimism. To name just a few, we still have historically low rates of unemployment. Corporations are flush with cash, stock buybacks are at record levels, and for the first time in a long time, valuations for both stocks and bonds are relatively attractive. An argument can be made, however, that the very high levels of pessimism seen with investors and consumers is the real reason to have optimism. At some point or at some price, expectations for the market, the economy, inflation, or from a geopolitical standpoint simply become so low that there is almost nowhere for them to go but up. So the obvious question is just, how low are expectations or sentiment today? These two charts paint an interesting and rather optimistic picture. Before we look closer at them, it's important to state that investor and consumer sentiment is typically a contrarian indicator. What that means is that the more negative the investor or consumer feels, the more positive it tends to be for future market returns. For example, the graph on the left is an indicator of how investors are feeling about the market. Investors are currently extremely bearish or negative, which is historically a very bullish or positive signal for markets going forward. The more detailed chart on the right tracks consumer sentiment over time, the gray line. And the blue dots point out high and low points along with what the S&P 500 did over the following 12 months. The average 12-month return when consumer sentiment hits a high point? Positive 4.1%. Positive, yes, but not particularly exciting or noteworthy. The average 12-month return after consumer sentiment hits a low point? Nearly 25%. Obviously, it's been considerably more profitable to buy when sentiment is low. As these two illustrations show, today's readings on both investors and consumers has rarely ever been lower. The simple explanation for this is the tendency to extrapolate and assume that whatever trend currently exists will continue on into the future or even indefinitely. That concept works in many areas of life and business, but when it comes to financial markets, the opposite tends to be true. Markets have a way of surprising us and going up when we least expect it. During difficult market or economic periods, that can be hard to accept or even believe. But it's also why we wanted to go through this exercise. When virtually everything we read or see on TV tells us things are bad or only going to get worse, it can be easy to fall into the trap of seeing only the negatives and making a hasty financial decision that we'll later regret. We don't know when, how, or from what point markets will eventually recover, but we are confident in saying that they will recover. During such times, it pays to stay the course and heed the advice of Warren Buffett, who famously said, "It is wise for investors to be fearful when others are greedy, and greedy when others are fearful." As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this segment.